While people were distracted by elections, wars, and stock market headlines, something far more structural shifted in the background. America's debt stopped behaving like a problem that could be managed and crossed into a regime where it dictates policy itself. This wasn't a headline event. There was no emergency press conference, no crash, just a line quietly passed in the math. The core event is simple to state. U.S. federal debt has reached a scale where the cost of servicing it now competes with the government's largest budget categories and grows faster than the economy that must support it. In 2008, total federal debt was about $10 trillion. By 2020, it was $23 trillion. Today, it sits above $34 trillion. That alone is not the trigger. The trigger is what happened next. Interest expense stopped being a rounding error and became a dominant flow. In fiscal year 2020, net interest cost was roughly $345 billion. By 2023, it exceeded $650 billion. Under current rate structures, projections for 2025-2026 place it in the $850 billion to $1.1 trillion range. That puts debt service on track to rival or surpass defense spending. It means the government is paying nearly $2-3 billion per day just to keep existing obligations alive. No new roads, no new systems, just carry cost. The crowd misses this because debt is usually discussed as a stock, not a flow. $34 trillion feels abstract, but flows determine behavior. What matters is not how big the pile is. It's how fast the interest meter is running relative to income. The U.S. government collects roughly $4.85 trillion in annual revenue in a strong year. When $1 trillion of that is structurally committed to interest, the remaining budget becomes a constrained system. Every policy choice must now compete with the debt itself. The forcing mechanism is the rate regime. For more than a decade after 2009, the Treasury financed itself at near zero rates. Average interest on outstanding debt drifted toward 1.5%. That era masked scale. But since 2022, the refinancing wall has been colliding with yields in the 4%, 5% range. Over $7 trillion in Treasuries roll within 12 months. Over $20 trillion matures within 4 years. Every rollover reprices legacy debt into a higher cost world. Now here's where it breaks. The system assumes growth will outrun interest, but nominal GDP grows around 4% to 5% in a healthy year. When the government's marginal borrowing cost approaches that same range, the stabilizing math disappears. Debt no longer dilutes through expansion, it compounds. This is not about default tomorrow, it's about regime change. Once debt service becomes politically and economically immovable, it begins to drive everything else: taxes, spending, inflation tolerance, monetary policy. The line is not bankruptcy, it is loss of flexibility. To understand why this line matters, you have to stop thinking about government debt like a household loan and start thinking about it like a rolling derivatives book. The U.S. does not pay off debt, it perpetually refinances it. Treasury bills mature in weeks. Notes in 2 on 10 years, bonds in 2030. Every month, hundreds of billions roll off and are replaced with new issuance at current market rates. That means the government's true exposure is not the headline $34 trillion. It is the weighted average interest rate on that stack, multiplied by the speed at which old debt is replaced. In 2021, that average rate was about 1.6%. By late 2024, it had risen above 3.2%. And it is still climbing because more low-rate paper is being replaced by 4%, 5% paper. Here's a concrete example. Assume $7 trillion of treasuries mature in the next 12 months, a reasonable approximation based on treasury schedules. If those are rolled from an average of 1.5% into 4.5%, that single cohort adds old interest, 7T x 1.5%, or 105B, new interest, 7T x 4.5%. or 315B incremental cost, 210B per year. That happens before any new deficit spending. Now repeat that process year after year as the rest of the curve reprices. Within 4 years, more than half the entire debt stock has been reset. This is why rates staying higher for longer is not just a market narrative, it is a fiscal shock. The Treasury is structurally short duration. It benefits from falling rates and is punished by rising ones. Every 100 basis point increase in the average cost of funding eventually translates into roughly $340 billion of additional annual interest expense once fully reflected. Now, layer in the deficit. The U.S. is currently running annual deficits in the $1.5–2.0 trillion range in non-recessionary conditions. That means new borrowing is being added on top of repriced borrowing. At 4.5%, $2 trillion of fresh issuance alone carries $90 billion in annual interest from day one. This is the compounding loop. Higher rates increase interest expense. Higher interest expense widens the deficit. Wider deficits require more issuance. More issuance must clear at market yields. Those yields feed back into step one. Unlike a company, the government cannot shrink its balance sheet in a downturn without causing economic contraction. Unlike a household, it cannot lock in a single rate for 30 years on the entire stack. It is permanently exposed to the front edge of the curve. This is the part most people miss. Monetary policy and fiscal policy are now fused through this channel. When the Federal Reserve holds rates at 5%, it is not just cooling housing and credit. It is actively accelerating the government's cost structure. That creates a political and financial tension. Either growth must rise to absorb it, taxes must rise to cover it, spending must fall to offset it, or inflation must be tolerated to erode it in real terms. Those are the only four exits. There is no fifth mechanism where the debt simply waits for a better environment. It reprices whether policymakers are ready or not. The line that was crossed is the one where interest expense becomes self-driving, a primary mover of deficits rather than a secondary outcome. Once a system crosses into this regime, the question stops being, is the debt big, and becomes, who is forced to act first? Because in leveraged systems, outcomes are not driven by preference. They are driven by constraint. The first trapped actor is the U.S. Treasury itself. It cannot choose not to refinance. Roughly $600–700 billion in treasuries mature every month. There's no pause button. If auctions fail, rates rise until they clear. If rates rise, interest expense expands. If interest expense expands, deficits widen. The Treasury is structurally compelled to borrow at whatever price the market demands. The second trapped actor is the Federal Reserve. In theory, it controls the price of money. In practice, it is now boxed between two incompatible mandates: controlling inflation and preserving fiscal stability. Holding rates higher for longer restrains price growth, but mechanically accelerates the government's interest burden. Cutting rates relieves the Treasury, but risks reigniting inflation, weakening the currency, and destabilizing expectations. This creates a binary constraint. Either rates stay high and the fiscal engine becomes politically unmanageable, or rates fall and inflation becomes the release valve. There is no third path where both problems disappear. Banks and institutional investors form the third pressure point. Commercial banks hold roughly $3–4 trillion in treasuries and agency securities. Insurance companies and pensions hold several trillion more. These institutions are duration sensitive. Rising yields reduce the market value of their balance sheets. That was the hidden stress behind the 2023 regional banking failures, where long-duration government bonds purchased at 1.5% lost 20% to 30% of market value when yields moved to 4% to 5%. Banks face a forced choice: either absorb mark-to-market losses or reduce duration exposure by selling into a rising yield environment. Both tighten financial conditions. Both feed back into slower growth and weaker tax receipts, worsening the fiscal position that created the pressure in the first place. Households are trapped differently. Mortgage rates near 7% freeze mobility. Auto loans at 8%, 10% suppress discretionary demand. Credit card APRs above 20% raise default risk. Slower consumption weakens growth, which undermines the very GDP expansion needed to stabilize debt ratios. The economy becomes less capable of outgrowing the burden. This is the structural bind. Every actor that could relieve the system is constrained by the same mechanism. History offers a parallel. In the late 1940s, U.S. federal debt exceeded 120% of GDP following World War II. The difference is how it was resolved. The Federal Reserve capped long-term yields at 2.5%, while inflation ran in the 4%, 8% range. The debt was not paid down. It was diluted through financial repression, negative real rates over a decade. What's similar is the scale. What's different is the starting point. In 1946, household leverage was low. Global capital mobility was limited. Today, debt is layered across governments, corporations, and consumers simultaneously. Capital moves at electronic speed. Inflation expectations transmit instantly through markets, so the system faces a forced equation. If rates remain high, fiscal stress intensifies, political pressure mounts, and growth weakens. If rates fall materially, the currency absorbs the adjustment and inflation risk rises. Either path imposes a cost. Someone must carry it. This is why reversal is so difficult. There is no constituency for austerity on a $34 trillion base. There is no appetite for sustained tax increases large enough to close a $1.5–2.0 trillion annual gap. And there is no painless way to grow nominal GDP by 7% to 8% for a decade in a mature economy. The trap is not ideological, it is mechanical. The system is now governed by rollover schedules, yield curves, and compounding interest. Intentions no longer dominate outcomes. This is where the abstraction collapses into arithmetic. The reason this problem is real is not ideology. It is that the numbers no longer reconcile under normal assumptions. Start with the base ratios. U.S. federal debt, 34 trillion nominal GDP, $27 trillion debt to GDP, 125%. That ratio alone is not fatal. Japan has carried higher. The critical variable is interest growth differential. If nominal GDP grows faster than the average interest rate on debt, the ratio can stabilize or even fall without austerity. If interest runs ahead of growth, the ratio rises even with balanced primary budgets. Let's define the moving parts. Nominal GDP growth, optimistic long run, 4%, need 5% average interest rate on debt, post-repricing path, 3.5%, 5.0%. Primary deficit, spending minus revenue before interest, 1.0, 1.5t annually. Now construct three labeled scenarios. Scenario A, optimistic growth. Assume nominal GDP grows at 5%, average interest settles at 3.5%, primary deficit narrows to 1.0t, debt dynamics, interest cost on 34t at 3.5%, shares 1.19t, total deficit should reach 1.0t plus 1.19t, share 2.19t, debt grows to 36.2t in 1 year, GDP grows to 28.35t, new ratio 128%. Even under optimistic assumptions, strong growth, moderate rates, and reduced deficits, the ratio rises. Scenario B, central case, assume nominal GDP grows at 4%. Average interest rises toward 4.5%. Primary deficit remains 1.5t, math interest 34t, x 4.5%, 1.53t, total deficit, or 3.03t, debt, 37.0t, GDP, 28.1t, ratio, 132%, scenario C, stress case. Assume nominal GDP slows to 3%, average interest reaches 5%, primary deficit expands to 2.0t and slowdown. Math, interest for 1.70t. Total deficit, my 370t debt, not 37.7t GDP, not 27.8t, ratio 136%. These are not extreme assumptions. They sit inside realistic macro ranges. The pattern is consistent. Debt grows faster than the economy in every case. This is why growth will save us is no longer a plan. It is a hope that the math does not support at current scale. Now add the flow mechanics. Treasury issuance in 2024 exceeded $2 trillion net. Gross issuance, rollovers plus new supply, was over $8 trillion. That supply must be absorbed by domestic banks, pensions, and insurers, foreign central banks, asset managers, the Federal Reserve indirectly via balance sheet policy. Foreign official holdings peaked around $7.6 trillion in 2021 and have since stagnated. China's treasury holdings alone fell from 1.3T in 2013 to under 800B. Japan's have oscillated but no longer grow structurally. The marginal buyer is increasingly domestic private capital at price-sensitive yields. That means clearing prices must rise to attract balance sheet capacity. Higher yields are not a market anomaly. They are the equilibrium response to scale. This is the part where normal expectations fail. In past cycles, debt expansion was cyclical. Recessions expanded deficits, recoveries narrowed them. Now the baseline itself is expansionary. There is no reversion point built into the structure. The line that was crossed is the one where stabilization requires conditions outside historical experience. Multi-year 6% plus nominal growth without inflation instability, or sustained political consensus for fiscal contraction of 4%, 5% of GDP annually. Neither has precedent in modern U.S. history. From here, markets stop treating debt as background. It becomes a price driver. When a system reaches this stage, markets do not respond in a single dramatic move. They react through a series of structural feedback loops that appear chaotic on the surface but are internally consistent. The first transmission channel is the yield curve itself. As issuance expands and maturity walls approach, the front and belly of the curve begin to carry a fiscal premium. Investors no longer price treasuries purely on inflation expectations and growth. They demand compensation for absorption risk. This is why 10-year yields can rise even as recession risk increases. The market is not forecasting strength. It is pricing scale. That produces a non-intuitive outcome. Bad economic news does not always lower yields. Weak data implies slower growth, which worsens debt ratios, which implies heavier future issuance, which pushes term premiums higher. The bond market begins to trade fiscal dynamics rather than business cycles. From there, the shock propagates outward. Equities reprice through discount rates. A move from 3% to 5% in the long end raises the hurdle rate for every cash flow in the economy. A company expected to earn $10 in 10 years is worth about $7.44 at 3%, but only $6.14 at 5%. That is a 17% valuation compression without any change in fundamentals. Multiply that across trillions in market cap. Credit spreads widen because higher base rates stress refinancing math. A BBB-rated firm rolling debt from 3% to 6% doubles interest expense. Margins shrink, leverage ratios worsen, downgrade risk rises. Funds that rely on stable spreads, risk parity, volatility targeting, credit arbitrage, reduce exposure simultaneously. Liquidity thins. This is where it starts to look irrational. Markets gap, correlations converge. Assets that should hedge each other fall together, but the driver is mechanical. Balance sheets are being forced to adjust to a higher carry environment. Then comes the volatility loop. Higher yields, lower asset prices, risk models delever, deleveraging, selling pressure, wider spreads and gaps, wider spreads, more model-driven reduction. This is not panic. It is arithmetic inside risk frameworks. Meanwhile, currency markets transmit the adjustment globally. If rates remain high, capital flows toward dollar assets. The dollar strengthens, emerging market financing tightens, trade partners experience imported disinflation or capital stress. If rates fall to relieve fiscal pressure, the opposite occurs. The dollar weakens, commodity prices rise, and inflation channels reopen. Either way, the adjustment moves through FX. What observers should watch is not headlines, but structure. The term premium on 10-30-year treasuries auction bid to cover ratios and tail sizes, credit spreads, especially BBB versus treasuries. The shape of the yield curve during weak data dollar index behavior relative to rate moves. Volatility indices during good news days. The signal is when markets stop responding to narratives and start responding to plumbing, when bonds sell off on soft growth, when equities fall on rate cuts, when supportive policy fails to lift prices. That is not dysfunction. It is the system repricing a world where debt is no longer passive. This is the phase where policy loses its clean transmission. Rate cuts do not automatically stimulate. Spending increases do not automatically reassure. Every lever pulls on the same constraint. And this is why reactions feel disjointed. Markets are no longer trading cycles. They are trading balance sheet limits. When a system enters a balance sheet-dominated regime, time horizons compress. The future stops being a distant abstraction and becomes a rolling sequence of funding windows, auctions, and policy inflection points. What matters is not the next decade in theory, but what unfolds across the next 24 hours, the next week, the next quarter. The immediate horizon is mechanical. Over the next 72 hours, markets respond to data through the lens of rates. Inflation prints, employment releases, and treasury auctions matter not because of their narrative, but because they shift expectations about funding cost. Watch how bonds react to good and bad news. When soft data fails to lower yields, or lowers them only briefly before they rise again, that is the regime asserting itself. Over the next 1 to 4 weeks, issuance dynamics dominate. Quarterly refunding announcements, auction tails, and dealer balance sheet strain reveal whether the system is absorbing scale smoothly or demanding higher premiums. Volatility spikes around auctions become structural, not episodic. Over the next quarter, the macro feedback loop appears. If yields remain elevated, housing slows further, corporate margins compress, and fiscal projections deteriorate. If yields fall sharply, currency and commodity channels reawaken. Either path confirms that adjustment is happening somewhere. From here, 3 scenarios define the landscape. 1. Base case. Slow compression rates remain elevated but volatile. The Federal Reserve signals caution. Inflation trends down unevenly. Growth slows but avoids collapse. Average funding cost drifts toward 4%, 4.5%. Deficits remain in the 1.5, 2.0 range. Debt ratios grind higher. Markets oscillate. Rallies fade. Sell-offs stabilize. Nothing breaks, but nothing resets. Indicators. 10-year yields hold above 4% despite soft data. Treasury auctions clear with modest tails. Credit spreads widen gradually. Equity multiples compress slowly. Dollar remains range-bound but firm. This is the entrapment path. Stability without relief. 2. Stress case. Liquidity fracture. Growth weakens while yields fail to fall meaningfully. Banks and funds reduce duration. Auction absorption weakens. Volatility spikes. 10-30-year yields rise into weak data. Credit spreads, gap policy faces urgency. The system forces a response. Indicators. Failed or heavily tailed auctions. Yield curve steepens in recession signals. Regional bank stress reappears. Equity drawdowns exceed 20% emergency policy communication. This is where the fiscal monetary boundary blurs. 3. Relief case. Financial repression returns. Rates fall not because inflation is defeated, but because the system cannot carry the load. The currency absorbs adjustment. Real yields compress. Nominal rates drop faster than inflation. Debt service stabilizes in real terms. Growth appears resilient, but the cost shifts. Indicators: aggressive forward guidance on rates, central bank balance sheet expansion, dollar weakness, commodity, inflation, rising inflation expectations. This is stabilization by dilution. The big picture takeaway is this: markets are no longer anchored primarily to growth cycles. They are anchored to balance sheet limits. The economy still matters, but it moves inside a corridor defined by funding capacity. America's debt did not explode. It crossed into a zone where policy must now orbit it. From here forward, every decision is constrained by rollover schedules and interest arithmetic. The system can adapt, it can function, but it cannot return to a world where debt is background. Understanding that shift is not about fear, it is about structure.